Lesson 15, Trading Pennants. Before we get started, I'd like to point out a couple things. In the top left-hand corner, you'll see a sign that says important information. During the presentation here, during this lesson, that sign will appear on certain pages. The information that's on that page is very important information that can play a big part in helping you as you trade. It can perhaps be a trader's tip. Pay attention to that information. You may want to memorize it and have it become a part of your methodology. The second thing I'd like to point out is in the bottom center of the page is a number. That is the number slide that we are currently on. That number matches the number in your workbook. If by chance you get lost during this presentation, look at the number of the slide and match it up with the number in your workbook. There's 16 lessons on trading the Forex to help you. This lesson, lesson 15, Trading Pennants, plays a big part in trading and in anticipating great profitable trades. Our focus here at MarketTraders.com is to take the market, which can be very, very complicated, and simplify it to where you can understand how to trade it and how to make money as you trade. Learning to trade the pennant is one of those very simplistic ways in learning how to trade the market. It is a part of technical analysis. These 16 lessons on trading the Forex are lessons on technical analysis. They are applicable to other markets that you trade. One of the most profound statements, as you've heard me say this before, is successful traders will do what unsuccessful traders can't and won't do. I commend you on taking the time to learn how to trade and to learn how the market works. Successful people think, act, and perform differently than unsuccessful people. They form habits of success. They are successful in spite of themselves because they've acquired a subconscious discipline that allows them to be successful. Please take the time to acquire that subconscious discipline so that you too can become a successful trader. There is a 21-day 3% rule which states the human mind forgets 80% of the knowledge it acquires within 3 days. If you don't use it, you lose it, because over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. By the end of this lesson, you will learn how to find an up and down price swing. You will learn why pennants form. You will learn that the market consolidates in a natural Fibonacci 618, 786 numerical sequence. You will learn how to find and draw a pennant. You will learn how to locate the buy and sell zones of the pennant. You will learn how to trade a pennant. You will learn how to create a trading plan with that pennant, and hopefully you will be disciplined and trade your plan. You will learn where to place your protective stop loss orders and how to financially protect yourself in every trade. Before we get started, let's review lesson 1 real quick. We're watching Japanese candlesticks which monitor the open, high, low, and close. The bullish candles are white candles. The bearish candles are black candles. We are watching a bid chart. There is a bid and an ask as we trade. This is like an auction. If you've ever been at an auction, there are bidders trying to buy. Bidders are always quoting a lower price than the auctioneer. They're trying to buy it cheaper. The bid price is lower than the ask price. The auctioneer is asking a higher price. He's offering the product for sale. That's where the bid ask comes from. In trading, there is a bid and an ask, and the ask price will always be higher. When it comes to trading currencies, the ask price is anywhere from 3 to 10 pips higher than the bid price. Please remember this. We are looking at bid charts, and we buy on the ask because buyers buy from sellers, and sellers sell to bidders, which means we sell on the bid. It's important information. Why is it important? It's because if you enter the market right now and you buy, you'll be buying on the ask. Here's the current price, 107.30, which means the ask price is 107.35. You have now been filled at 107.35, not 107.30. Every buy needs two sells, one for a protective loss stop and one for a limit to get out. Your sell stops as well as your sell limit on a buy will be on the bid. All this candle has to do is hit that number and chances are you are filled. Here's where it really comes into play because we sell on the bid. If we enter the market right now, we're filled at 107.30. The ask price is higher. If we place a protective loss stop, all it takes is for the market to come up, and the candle does not have to hit that because the ask price is higher than the bid. The ask will hit your buy stop before the candle will. Many times the candle comes up, doesn't hit your ask price, the prices fall again. You are really excited and thankful that you're not stopped out, yet you are stopped out. So just in case when the market gets close to your price, always confirm and understand whether you are whether your stop is on the bid or the ask. Understand that so that you can properly understand what you should do next as you continue to trade. The types of orders we use are market orders. That's an order placed to enter or exit the market at the market price, either the bid or the ask, or whatever the market price is at the time of execution. The second order is a limit order. That's an order placed to enter or exit the market at the exact place price or better with no slippage. Now, a stop order is an order placed to enter or exit the market at an exact price that turns into a market order when touched and may incur slippage. These are the rules as you trade. If this is where the market is, any order placed above or below the market that is not a filled order is what's called an open or working unfilled order. And if you place an order to buy above the market, that's called a stop order. If you place an order to sell above the market, that's called a limit order. If you place an order to buy below the market, that's called a limit order. If you place an order to sell below the market, that's called a stop order. It's something that may be difficult to memorize at first, but it will become natural as you begin to trade. Ordering rules. Every bull that enters the market should have two sells, one for a potential loss and one for profit. Let's look at this chart. If you buy to enter the market here, your protective loss stop order should be at the last low, which would be a sell stop. Every buy should have two sells, one for loss and one for profit. Now, focus in on your losses first and the profits will take care of themselves. Ordering rules. Every sell should have two buys, one for potential loss and one for profit. Let's look at this chart. If you enter the market selling, your stop loss order should go at the last high and it will be a buy stop. Every sell has two buys, one for potential loss and one for profit. OCO means whichever order the market hits first, it will cancel the other order. Whether you are buying or selling, you will need two opposing orders, one for profit and one for loss. Whichever the market hits first will cancel the other order, therefore you're not left with an open order. Cancel and replacing. We focus in on cancel and replacing in lesson 16 as well as lesson 3. Remember this important tip. Only cancel and replace as you are chasing the market to the last low after the market has made a new high when you are canceling and replacing in an uptrend. When you are canceling and replacing in a downtrend, only cancel and replace to the new last high after the market has made a new low. Sometimes it's very difficult, especially during periods like this, to stay in there, but you don't want to get stopped out prematurely. Technical traders learn to read charts just like doctors learn to read x-rays. To the trained eye, charts are telling a story. Technical analysis gives a trader a high probability of knowing where the market is going. Why do you think that's so? I'll tell you why. Who trades in the market? Banks, financial institutions, investors? That's partially true. But those banks and institutions and investors are people. They are creatures of habit. People are creatures of habit. Charts do nothing more than monitor the buying and selling habits of people. And since people are creatures of habit, we become predictable. That's why charts can become predictable, and that's why people that study charts, technical analysts, can create and understand and have a high probability of knowing where the market is going to go. And because a chart is a chart is a chart, technical analysis is applicable to all financial products, which means once you've educated yourself on how the market works, you can start to control your financial future. I'd like to do a quick review on support and resistance, which is lesson 2. Keep in mind that a high is the wick or the body of a candle that is higher than the 2 candles to the left and 2 candles to the right, and that not all highs are resistance. A low is the wick or the candle which is lower than 2 candles to the left and 2 candles to the right, and that not all lows are support. What we're trying to do is teach you to train your eyes to scan a chart. If this is where the market is, we want your eyes to scan a chart and be able to see all your levels of resistance and all your levels of support. Keep in mind the financial game, don't underestimate it, that we show you in lesson 2, which is if bulls take control, they're going to try to take out all these old levels of resistance and establish a new level of resistance. If the bears take control, they're going to try to take out all these lows and establish a new level of support. Your protective stop loss orders must be at the last high if you're buying and the last low, let me back up here again. All protective stop loss orders must be at the last low if you're buying and the last high if you're selling. Now let's look at this chart. If you are buying, your protective stop loss order must be at the last low or level of support. If you are a bear and you're selling, your protective stop loss order must be at the last high or level of resistance. If the stop order is too far away from the entry point that you are trying to get in and does not meet your equity management requirements, then pass on the trade. Don't risk more than you should. And your level of risk is pointed out in lesson 3 called equity management. Now before we move on, I'd like to review trends and trend lines just briefly. Keep in mind that an uptrend is when the market is making higher highs and higher lows, and that in order to find your uptrend line, you draw your trend line across the lows of support, just as you see it here in this chart. In an uptrend, there are 3 primary trend lines that we're constantly monitoring: the inner, outer, and long-term trend line. Lesson 5 teaches you where to enter the market at trend lines. In a downtrend, it works the exact opposite. A downtrend is creating lower lows and lower highs. When you spot a downtrend, you will draw your trend line across the highs of resistance, just like you see it in this chart. There are 3 trend lines that we're monitoring in a downtrend. One is called an outer, long term, plain old outer, and an inner. A quick review of lesson 7 is necessary for understanding your pennants, and that is where we learned that the market moves in a natural harmonic vibratory sequence, a numerical sequence called Fibonacci sequence. Leonardo Fibonacci in the year 900 AD discovered this numerical sequence. It's where the sum of the previous 2 equal the sum of the next. He started playing around with ratios in those numbers and started dividing the numbers. Where you take 89 divided by 144, you come up with 0.618. You take 144 divided by 233, you come up with 0.618. As you start to divide all these numbers, we came up with important ratio numbers that we can use in the market. One is a 382, a 50, a 618, a 786, a 1.27, and a 1.618. And we assigned certain ratios to other ratio extension numbers. Now, Fibonacci ratios are hidden levels of support in an upswing, which means as the market rallies and it retraces, if the upswing is going to stay consistent, it will bounce at one of these Fibonacci numbers. If it bounces at a 382, 50, or 618, it should go to a 1.618, just as you see in this chart. Market rallies, retraces to the 382. This is the 382, 50, 618, 786. These are your extensions, 1.27, 1.618. If the market retraces all the way to a 786, bounces, U-turns, rallies, and takes out the previous high, it will only go to a 1.27 extension. The market is signaling to the trader that it is slowing down when it bounces at a 786. We also learn that the market moves at different speeds. At a 382 bounce, it is very fast and aggressive. At a 786 bounce, it is slowing down. Downswings work exactly opposite, but in the same numerical sequence. In a downswing, if the market, as it retraces, bounces at one of these numbers then become hidden levels of potential resistance. Now in a downswing, if the market bounces at a 382, 50, or 618, U-turns, takes out the previous low, it should go to the 1.618, just as you see in this chart. This is the downswing. These are the retracements, 382, 50, 618, 786. This would be a return of 100%. It bounced at a 382, U-turned. This then becomes the extension, the 1.27 extension, 1.618 extension. There's the bounce. If it bounces at a 382, it should go to a 1.618. If the market bounces at a 786, it is slowing down. If it bounces there, U-turns, takes out the low, it should only go to the 1.27 as you see it here. Here's the original swing. There's the 786 bounce. There's where it went to the 1.27 extension. If you have a data provider that does not have the Fibonacci numbers on it, please give us a call and we'll hook you up with a great data provider that has all the Fibonacci tools. Keep in mind, once again, in a downswing, a 382 bounce is very fast and aggressive. As it bounces to a 50, 618, or 786, it is slowing down. And the reason you want to trade 618, 786 bounces in the direction of the trend is just in case the market decides to top out there, reverse, U-turn, your losses will be small. Here's another important information. If you listen to the market with your eyes and look where it has been, it will tell you where it's going to go. Now, let's look at this chart. Market rallied, retraced, bounced at a 618, which means if we entered at a 618, we planned on getting out at a 1.618. But instead, when it rallied, it did not take out the previous high. It U-turned and came back to the 786. This formation is called a Gartley. Well worth your investment to purchase lesson 13 and understand how the Gartley works. Here, with a new adjusted trend line, bounces at a 786 and rallies to the 1.27 extension, which means if we entered the 618 with anticipation of getting out at a 1.618, we would now need to adjust our limit profit order to the 1.27. Now, lesson 15, trading pennants. I really enjoy this lesson because it simplifies how the market works. And instead of really making things difficult, understanding how a pennant works makes it very easy to trade. It all begins with understanding how water works and how water sits out on the ocean, or even, if you will, a lake, a pond. If you've ever looked out on a lake, you'll see calm water if the wind's not blowing and it's a beautiful day. And as you've looked at calm water, have you ever watched a boat go by And as that boat goes by, it starts to create waves. If you've ever been on a cruise and you've looked over the side of the ship, you've seen these big waves from the ship going through the water. And as you look back, you start to see the waves dissipate, just like you see here. Look at all this ship went through there, and the water starts to wave back and forth, and with gravity starts to pull it back and forth until it dissipates. Well, these waves vibrate until they dissipate. And look at this chart. Look at how the market vibrates until it slowly starts to dissipate. It vibrates just like water, and it waves just like water. Well, this waving movement is called a pennant. When the market waves back and forth, getting tighter and tighter and tighter, that is called a pennant. Look at how the market rallied and then slowly started to wave. This is what's called a flagpole pennant. Now here's a trading exercise. Now that I've explained to you just a little bit about what a pennant is, I'd like you to go and find pennants on your own, because the best way to understand what you've learned is to write down what you think you know, then go back after you've been taught and look at what you thought you knew versus now what you now know. Your perception's your reality, my perception's my reality. The focus of this lesson is to teach you market traders' perception of technical analysis to where you can become profitable as you trade. Now, can you find the pennants in this chart? Put your machine on pause. Draw out any pennant you see. Find the pennant in this chart. This is a Swiss franc 2-hour chart. Pennants work on all time frames. Put your machine on pause. Can you find the pennant in this chart? This is a Japanese yen 15-minute chart. Pennants work on all time frames. Put your machine on pause. Here is a daily chart, which means each one of these candles represents a day. Can you find the pennants in this daily chart? Put your machine on pause. Here's a Euro 30-minute chart. Can you find the pennants in this chart? Put your machine on pause. Now in Lesson 9 on consolidation and Lesson 7 on price swings and Fibonacci numbers, we learned that in sideways market it waves in a numerical sequence. Remember the boat going through the market and the market started to wave? If you start to take your Fibonacci's and spreading them over the price swings, you will see from this low to that high, that's a 786. And from that high to that low, that's a 786. And from that low to that high, that's a 786. And from that high to that low, that's a 786. Let's look at it on a chart. From that high to that low, that's a 618. From that low to that high, that's a 786. From that high to that low, that's a 786. From that low to that high, that's a 786. And from that high to that low, that's a 786. See how it moves in a Fibonacci ratio sequence? Now, the wave vibrates in this Fibonacci sequence until it dissipates. Markets pennant and accumulate and consolidate and bracket for two main reasons. One, prices have reached the value that traders are not willing to pay, not more, not less for that product anymore. Traders are not trading and maybe waiting for a fundamental announcement. Now, what's a fundamental announcement? A fundamental announcement is a report. See, a country is like a business. There are approximately 14 reports produced in a country that account for the profit and loss statement of that country. Those reports are called fundamental announcement. Each financial market has its own fundamental announcement. Now envision Microsoft. They have to issue a report that talks about the financial well-being of the company. Now, if Microsoft makes an announcement that Bill Gates is going to retire, that is a fundamental announcement. If Microsoft gives out a report that says they're losing money, that is a fundamental announcement that talks about its overall health and well-being as a company. If Microsoft gives out a report that says its receivables or payables are higher or lower than they should be, that's a fundamental announcement that can create a difference in value of their share value. Well, countries have equal reports, and there are approximately 14 reports that monitor the overall health and well-being of a country. For example, unemployment, interest rates, housing starts, inventories, retail sales. All these fundamental announcements are found on a website. But there are 3 trading sessions in every 24 hours. The Forex opens approximately 7 p.m. Eastern Standard Time on Sunday evening and closes at 4 p.m. Eastern Standard Time. Every 24 hours there are 3 trading sessions. Asia opens up at 7 p.m. and closes at 6 a.m. Eastern Standard Time. Europe opens up at 2 a.m. and closes at 11 a.m. Eastern Standard Time. You can see that Europe and Asia open up or overlap each other. U.S. opens up at 8 a.m. and closes at 5 p.m. You can see that Europe and the U.S. overlap each other. Well, each one of these countries, the major countries, for example, over in Asia, Japan, China, Korea, Australia, when they have a fundamental announcement, it can create a movement in the market, in the currencies. Europe, major countries over there, England, Switzerland, Germany. When they have a fundamental announcement, it can create movement in the market. The United States, when the United States has an announcement of unemployment, interest rates, retail trade, import-exports, it can make movement in the market. I would like to point out that ForexTips.com monitors the economic calendar. Fundamental announcements shift the value of the economy, and there are main reasons for price change and breakouts which can create large price swings and trading ranges in the market. ForexTips.com monitors and posts all those fundamental announcements on its website. Look up here, ForexTips.com. After you have become a member of ForexTips.com, you will get a password. All you do is click on the member login and go to the fundamental announcements. We monitor, it gives you the date, the time, the location of the announcement, and the description of the announcement. I would like to point out that monthly, quarterly, and yearly announcements move the market more than weekly announcements. And whenever you have a monthly, quarterly, or yearly announcement, you should expect more volatility than just weekly announcements. Now let's look at this water again. See how it's calm? A fundamental announcement is like the boat going through the water, which creates the initial wave. The market had a fundamental announcement here. That creates the first initial wave. Then, after the announcement was made, which created a change in value on the Japanese yen, this is Japanese yen 2-hour chart, it created a change in value. Prices went literally from 122 all the way down to about 119. Actually, went to a low of 119.06. After there was a change in value, the market started to vibrate and slowly dissipate. Now, pennants usually form after a fundamental announcement or right before a fundamental announcement. When traders spot a pennant, which is a form of consolidation, they anticipate a breakout. Now, the term breakout is when prices break out of a sideways pattern or pennant accumulation and break through either support or resistance. If the bulls take control of the market, they will establish new highs. If the bears take control, they will establish new lows. Now let's look at this. A breakout is when prices break through that pennant, that line of support or resistance, and when the market is pennanting, many times you don't know which way it's going to break out. But when it finally breaks out of that pennant, it will either break through resistance, the line of resistance, or the line of support. Let's look at this chart. See how we had a pennant down here? It slowly penanted, obviously before a fundamental announcement. Now look at how after the fundamental announcement, the market slowly started to pennant again, and it slowly penanted, getting tighter and tighter and tighter in its levels of resistance and support until the next fundamental announcement. And then it broke out again. Now here's a trading exercise. Now that I have explained to you how to find these pennants, you find the pennants in these following charts now that you know a little more. And when you think you see a pennant, draw your lines across all the highs of resistance and all the lows of support. And the highs and lows should be getting closer together. Now here's your first chart. Draw the pennants. Put this machine or this lesson on pause and draw all the pennants. This is what you should have come up with. This was a British pound 4-hour chart. Now, find all the pennants on this one. This is a Swiss franc 2-hour chart. Put this lesson on pause and draw out all the lessons. Draw out all the pennants. This is what you should have found. Here is a Japanese yen 15-minute chart. Put the machine on pause and find all the pennants. This is what you should have found. Here is a daily chart, which means each candle is a daily chart. Find all the pennants. Put this on pause and find all the pennants. This is what you should have found. Did you find all these? Here's another one. If you find the pennants on this one, I commend you. This is a Euro 30-minute chart. Put your machine on pause and find the pennants. Here is the pennant that I wanted you to look for. It's called a diamond pennant. See how it expanded out and then contracted, then it broke out? You'll also see, here's another little pennant too. They call these flagpole pennants. It rallied up, slowly penanted, and then it broke out again. Now, as the market pennants, it creates what's called buy and sell zones. These are very similar to the buy and sell zones that you learn in lesson 6 when a trend line is being broken. But a trend line is being broken from a pennant of a resistant trend line and a pennant of support trend line. Now look at how when the market broke out, as it broke out to the north of this pennant, it entered into a buy zone because the north side of the pennant is the buy zone, the south side is the sell zone. Look at how when it broke out here again, it broke out to the north, it entered into the buy zone. Everything on the south side of the pennant is the sell zone. Now trading is all about understanding price movement against time. Here is time, here is price movement. Price and time usually move together to meet up to an objective. Now as time is used up, the trend lines move closer together. When the market tightens to the point that the trend lines are about to touch, it will be at that time that the market will break out. And what's very amazing is that as the market vibrates and tightens, it usually comes to a point right before a fundamental announcement. So what you hopefully want to find is either consolidation or a pennant before a breakout, because they become very easy to trade. Now when a complete candle or wick breaks out to the north, the market has entered into the buy zone. And so when you finally have a clear candle on the north side of the trend line of resistance and it's entered into the buy zone, you will place your order to enter into the market on the next candle. Now you must wait until you have a completely closed candle. Do not enter the market just because a candle is breaking support or resistance. It could be a false spike. Let's look at this. Here was the pennant. Market started to break out. At one time, this was a bullish candle, but it was not completely closed. Let's look at this one. Broke out, but it still came inside the pennant. Do not enter while a candle is forming. Wait until the candle has closed. Now, the market breaks out into the buy zone, and it now has a bullish clear candle right here, wick and all, on the north side of the buy zone. That then becomes the sign to enter the market buying. So this is what we will do. We will buy at the opening of the next candle, placing our protective stop loss order at the last low. Now, when a complete bearish candle enters into the sell zone, that's the sign for us to enter the market and short the market. The market is breaking out of the pennant. So we will place an order to sell at the opening of the next candle if equity management allows. And once again, you must wait until you have a completely closed candle. Do not enter the market just because a candle is breaking support or resistance. Let's look at here. See how the market broke out, but you don't have a clear bearish candle. The market was still pennanting to a degree. You must wait till you have a clear bearish candle, which means now that the market broke out of this pennant, this then becomes the sign to enter the market. We will sell because this candle is a complete clear candle. We will sell at the opening of the next candle. Look at how the market moved in our direction from entry. Now here's a trading exercise. Let's trade a pennant and watch what happens. Turn on your trading software as you practice. We have trading software that allows you to practice with monopoly money so that you don't have to use real money as you learn. Doctors operate on cadavers first, don't they? Let's practice with monopoly money and hone in on our skills before we put dime number one. Now here's the rules to trading the pennant. Find and draw all your trend lines of the pennant. This will help you define the pennant or if the market is pennanting. Wait until the market breaks the trend line of the pennant and enters either the buy or sell zone by clearing a bullish candle for the buy zone or a bearish candle for the sell zone. Find where your latest levels of support are in the buy zone breakout. Determine where your protective stop loss order would go, because if it breaks out to the north, your stop's at the last low. Find out where your levels of resistance are, because if it breaks out to the south, your stop loss order will go at the last high. If you can't afford the potential loss, should the trade not work out, then stay out. Pull out your trader's checklist and create a trading plan and trade that plan. Now let's face the facts. Every trader wants the market to move in their direction from entry. Education on how the market works will improve those percentages. Let's look at how the market moves in our direction from entry just solely based on our education of the buy and sell zone. Now pennants move in a Fibonacci numerical sequence, which is less than 7, and they move in what's called harmonic beats. So please replay, and if you haven't purchased less than 7 or 14, purchase them. They're well worth the investment. Combine your knowledge of support and resistance, price swings, and Fibonacci numbers, trends, and trend lines while trading the pennant. Now you turn on your machine and this is what you see. You see a pennant. Draw it out. Let's see if you see the same pennant that I see. This is called a flagpole pennant. There it is. I then draw my lines of resistance coming down and support going up. And what I must do now is I must wait for a breakout, because trading is all about understanding price movement against time. So I pose this question: if it breaks out to the north or to the south, where will your stop go? Well, if it breaks out to the south, my stop will go at the last high, which may be right here. If it breaks out to the north, my protective stop loss order will go to the last low, which may be right here. Either way, I don't care which way it breaks out. That's why I really enjoy trading pennants, because this is kind of like a no-brainer trade. All it has to do is break through resistance, clear me a bullish candle, I'm in. Or it has to break through support, clear me a bearish candle, I'm in, if equity management allows. Now, here I sit and I wait, because I've bought into my trader's mantra: I will wait until the market meets my conditions and my terms, or I will not trade. I now have one clear candle in the buy zone. Look at how it broke out to the north. I now have a clear candle, which means that's the sign for me to enter the market at the next candle. But here's important information. Before you enter the market, you need to decide to be either a day trader or a position trader. So if you're going to be a day trader, figure out your Fibonacci numbers and your extension for profit. If you're going to be position trader, you may want to cancel and replace. Please understand how to properly cancel and replace. But now that I have a clear candle in the buy zone, I'm going to place my stop loss order at the last low. Pull out your paper trading form. Make sure you have found all your levels of support and resistance and understand the financial game. Place all your buys. Here's a buy. Every buy has two sells. Put your price here, your stops and your limits there. We are entering the buy zone. Fill out your paperwork just in case your computer crashes. And this also serves as a great tool to go back and review what you have done. Now, the market rallies. We bought right here at the opening of the next candle. Look at how the market just took off in our direction from time of entry. And that's what every trader wants. Now, understanding Lesson 10, Trading Days and Trending Days, will help you understand when the market breaks out, how far it will go. What's amazing is you can start to predict and educate yourself how far the market will go. Your software monitors your P&L, but go back to your trading form and figure out your profit and loss statement. I'd like to say this. Remember that as you paper trade, you are forming a habit. So there's no cheating, there's no pretending, there's only accurate paper trading, because that habit you'll carry over as you trade with real money. Now, there are different shaped pennants I would like to point out, and they come in all time frames. These pennants are called flag pennants, ascending triangle pennants, descending triangle pennants, and diamond pennants, and you trade them all the same. Now, this is what a flagpole pennant looks like. The market is equally bouncing at support and resistance, getting tighter after each bounce. Let's look at it. Looks like a flagpole, doesn't it? Bouncing, 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 getting tighter with each bounce. Let's look at it on a real chart. See how the market came up, bounced, 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 getting tighter, and then it breaks out. Look at here. Bounces, 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 finally breaks out, and then enters into the sell zone. This becomes a clear candle, and look at how it takes off in our direction. Ascending pennants is when the market creates equal levels of resistance and higher levels of support as it consolidates. See how as it slowly consolidates and bounces, it keeps going up to the same level of resistance, but it creates higher lows. Look at it here. Here is an ascending pennant. The lows are higher lows, and then finally it breaks out. Here once again, on ascending pennants, they usually break out to the north. I kind of liken it to this. See how you have this level of resistance here? Look at how this arrow is pointing up. That kind of tells you the direction that's going to break out. When you have equal levels of resistance, let the arrow point in the direction that it's going to break out. Look at this ascending pennant. See how most ascending pennants break out to the north? This one did not. But the question I pose to you is, if you're following the rules of the pennant, that the market either enters the buy zone or the sell zone, did it really matter? Because here then became the signal to short the market. It really doesn't matter. Even though it's supposed to do one thing, it doesn't matter if you're following the rules. In a descending pennant, it's the opposite of an ascending pennant. The market creates equal levels of support and lower levels of resistance. See how resistance is descending, creating lower highs? Let's look at it on a chart. See how the arrow points in the direction of the breakout? Market creates equal lows and lower highs. It's called a descending pennant. Now here's a diamond-shaped pennant. That's where the market broke out, starts to calm down, but slowly expands, then contracts, then breaks out. Let's look at it here. Look at how the market expanded. It's almost like creating an opposite pennant going this way and another pennant going this way if I was to divide it in half. But be that as it may, a diamond pennant expands out, then contracts, then breaks out. The rules of the pennant are the same on all these. Now, here's the trading rules for trading the pennant, and they're applicable to all pennants. Flagpole, ascending, descending, diamond pennants, the rules are the same. The market enters into the buy zone or sell zone. Now, when a pennant reverses, you must reverse as well. And always check your equity management. If you can't afford the loss, don't trade. But look at how the market slowly started to pennant. It broke out. You entered the sell zone right here. You turned, came up, bounced off of the opposite side of the trend line, which it usually does, which is also the 7/8 of this downswing, bounces there, but then slowly pennants again. You can kind of see that pennant right there. Breaks out to the north. Now, in this case, you will need to go with it, which is, here was your sell, there was your protective stop. As soon as it came up to stop you out, you need to reverse your position and go with it. If you understand your Fibonacci's, which is lesson 7, you will have already reversed your position right here at the 786, because we've learned in lesson 7 that the 786 is the last level of potential resistance in a downtrend, which that's what this is starting to do, create a downtrend. We got in the sell zone. If we shorted it here with our stop up here at this last high, now that it bounced at the 786, we can cancel and replace our stop to the 786 high and save us some money, just in case the trade doesn't work out. If we would have canceled, replaced our stop to the 786 high, which is the last level of resistance in a downtrend, we would be reversing our position here instead of here. Be that as it may, if the market reverses from the sell zone or the buy zone, you need to reverse it and go with it. If you feel uncomfortable, when in doubt, stay out. Now, if the swings are large enough, you can trade inside the pennant. Let's look at this pennant. See how this pennant is creating a level of resistance and a level of support? Every time the market comes up and hits that level of resistance, sell it. Short the market here, then get out here, reverse your position, buy, then sell, then buy, then sell, then buy. All this could become profit. Let's look at this. In order to see whether you're in a large enough time frame, we're on a 2-hour time frame. First, find a large pennant in a large time frame. And now that we're no longer on a 30-minute chart, we've gone up to a 2-hour chart. Look at how the pennant, these are 200 pip swings. If we shorted the market here and got out here, that became profit. If we bought here and then got out here, that became profit. If we shorted the market here and got out here, this became profit. If we reversed our position, bought here, this became profit. Look at how we bought all these levels of support and we sold all these levels of resistance. And the reason why you want to trade the 618 and 786 bounces is just in case the market breaks out, it'll stop you out. You will then be in a buy or sell zone, and you'll need to go with it. But let's look at this now on an hourly chart. Look what we turn to a smaller chart. Let's look at the pennant now. Sell, buy, sell, buy, sell. Pennants that are created on large time frame offer great trading opportunities. Now, remember at the very beginning of our lesson, I said the best way to understand what you've learned is to write down what you think you know, then go back after you have been taught and look at what you thought you knew versus what you now know, because your perception is your reality. Let's see if your perception of a pennant has changed. Put this machine on pause, go find this chart, what you wrote down, and let's see if you found these same pennants. On this British pound 4-hour chart, did you find these pennants? On your Swiss franc 2-hour chart, did you find these pennants? Do you see the buy zone, the sell zone? Do you see the trading opportunities? Buying here, look at all that profit. Buying here when it finally breaks out, look at all that profit. On this 15-minute chart, did you find these pennants? Look at this. Clear bearish candle. Look at this opportunity. Huge trading opportunity right there. On this daily chart, did you find these pennants? Did you see all these buy and sell zones? Trading pennants are very, very easy to find to me, and hopefully they are and will be to you, because they are also easy to trade. In this chart, did you find this pennant? This is a diamond pennant. See how it expanded out and then contracted? Go into your software and turn on your computer and go look for pennants. Educate yourself on how these pennants work. Here are the rules to trading the pennant in the buy and sell zone. They're the same. In closing, let's all agree. You've got to have an edge. You've got to educate yourself so you know where to get in and you know where to get out. Let's all agree that the markets form pennants, and that when we spot a pennant, a great trading opportunity appears. And if that pennant matches our equity management, then we can trade it, and it can become very profitable. Can we all agree that you need to understand that when you find a pennant, you must create a trading plan and trade that plan? Now, did this lesson teach you how to find an up and down price swing? Did it teach you why pennants form? Did it teach you that the markets consolidate in a natural 618-786 Fibonacci numerical sequence? Did this lesson teach you how to find and draw a pennant? Did it teach you how to locate the buy and sell zones of the pennant? Did it teach you how to trade the pennant? Did it teach you how to create a trading plan and trade that plan? And did it teach you where to place your protective stop loss orders as you trade the pennant? And that if the equity was too great to pass on the pennant trade? If this lesson did not achieve that, then go back and replay it. Because understanding how the pennant works can literally participate in placing you in the 10% success rate of trading in the market, because 90% of most novice traders fail. Remember, successful traders will do what unsuccessful traders won't do. They will take the time to properly educate themselves about how the market works. Because in reality, there's two ways that you can pay for your education. One is to try to become lucky. People that are jumping in the market based on luck are basically gambling. People that jump in the market based on a hot tip are gambling. Because if you have to be told where to get in, you're going to have to be told where to get out. And it will only be a matter of time that you'll become unlucky and you'll lose everything you started with. The saddest part about losing everything you started with is this. You do not have the education to go earn that money back. That's why paying for these lessons are well worth your time, your investment of money, and your investment of time. Because being mentored by somebody who understands how the market works is the second way to properly pay for this education. And when you hook yourself up with a mentor, a trading coach, it's like buying a map to a gold mine. We show you where the gold is. Now you need to have the discipline to properly extract that gold based on a set of rules and an education of knowing where to get in and why, and knowing where to get out and why. Let's face the facts. All of us as traders want the market to move in our direction from entry. We're all looking for comfort in the numbers that we choose, and education on how the market works improves those percentages. These 16 lessons focus in on technical analysis. These 16 lessons can play a big part in your success in trading, not only on the Forex, but in other products. They all come with trading exercises, because our focus is to have you buy into this trader's mantra, which is, I will educate myself on how the market works, I will learn how to find and place a trade, I will trade with equity management, I will never trade without a protective stop loss order, I will not chase the market, I will be patient and wait till the market sets up and meets the criteria of my trade, or I will not trade. Now, because it takes some spatial education, we're looking at a chart just like a doctor looks at an x-ray. Remember, if the chart is not clear and doesn't visually make sense, when in doubt, stay out. But if you have the urge to trade and you're still in doubt, go into forextips.com. We monitor a chat room 24 hours a day to help you as a trader learn how to trade. Because of this 21-day 3% rule, let me remind you again, if you don't use it, you lose it. Our focus is to get you at 85 to 95% recall before you trade. And on behalf of everybody at Market Traders Institute and forextips.com, we'd like to say thank you for investing in yourself and purchasing this lesson.